Okay, I fixed it. It was the second monitor. The settings on the second monitor were off, so I couldn't see anything on the bottom of the screen. And that's how you add kind of my face and my sound to the stream. Hey, what's up? So I like this these financial statements I put together. I did two videos just showing you how to connect the balance sheet, income statement, and statement of cash flows. I just kind of made this up, and I think it kind of makes it really easy to understand. Um, so I just kind of created a fake company called Slippers Beyond Retail, and each year we're going to do their financials, and you'll see how things kind of move between the statements. Um, so the first thing we're going to do for the company is you generally add cash when you start a new company. So we're going to add 5 million of cash. So that's just coming out of our pocket. We could have saved it up from prior years, or we could have sold another business. Doesn't really matter. It's not part of. Only the cash is the important part. How we got it is irrelevant. It's not part of the business. So the first step is to add cash. So 5, 1, 2, 3, 1, 2, 3. So we have 5 million of cash onto the balance sheet, and 5 million under owner's equity, because assets have to equal liabilities plus equity. So we can't put it as a liability. It's equity. And you see it says owner's equity. So we're going to IPO, I think, in 2022. We're going to IPO, and then it'll say shareholders equity. But right now, there's no shareholders. It's just us, the owner. Even if there's multiple owners, IEA, I just did a video today on them. I like them a lot, but it's pretty cheap stock. It's what is it? It's only a few hundred million market cap. But I just did a video on them today. It seems like a lot of upside. And then so generally, pretty much what this company does is they buy slippers, like the raw materials, and then they make them nice, and then they sell them wholesale and manufacturing. That's why it's called Slippers Beyond Retail. It's beyond retail. So we're just doing manufacturing and wholesaling. So there's a company we get all our inventory from. The company is Slippy, and we're going to buy $1 million of inventory. So we have to increase inventory $1 million and minus cash, because we have to send them $1 million to buy the inventory. So we're going to minus $1 million from inventory, cash, and send them a check for $1 million, and he's going to send us $1 million of inventory. So I don't know what that is. Sub at A. This is a pretty simplified company. It could get a little more complex, but I try to make it real simple. And now what we do is we take the inventory we bought from this company, Slippy, who sent us generic slippers, and we make them nice. We design them. And then once they're really nice, we sell them. And Walmart is our only customer. So we sell our entire inventory, all 1 million, to Walmart. So we have to minus that $1 million from inventory. And then that goes in the cost of revenue. Because that's how much it cost us. the expenses it cost us. So that goes into on our income statement. And we obviously have to receive more than $1 million from Walmart. They're going to give us $2 million. That's our markup. We just double what we paid. So they're going to send us $2 million in cash. So we add $2 million to cash, and then $2 million goes into revenue because we have to book the revenue once we ship the slippers out to Walmart. We have to book the revenue onto the income statement. But it is possible we don't receive cash, even if we didn't receive any money for it. Like we sold them on credit, which we will do in later years. But in this case, they sent us cash. The first year is going to be pretty simple. And we have 10 employees, 10 workers, and they get paid $50,000 each. So that's $500,000. So we have to minus that from cash. And since they're the ones who kind of made the slippers, it goes in the cost of revenue because they're part of the process to make the product. So we put $500,000 in the cost of revenue. So it cost us $1.5 million to buy the raw materials and then to pay our employees to design them, and we charged $2 million. Now we have to pay taxes. So I'm just going to make us 20% on our gross profit. Every year is going to be 20%. So $100,000 in taxes. So we have to minus $100,000 from cash. I think I added in a zero. I added in a zero before. It should be 500,000, not 5 million. So minus 100,000 cash. And then we put $100,000 onto the income statement account, taxes. And we mail the check to the IRS for $100,000. It doesn't balance the balance sheet. You see, assets is 5 million, equity is 5.4 million, equity is 5 million. Do you know why it doesn't balance? Does anybody know why? Because it should always balance, right? So at the end of every reporting period, you have to wipe out net income. Because in the start of 2021, we're not going to have anything on the income statement when the very first day of 2021. It's going to be all zeros. The balance sheet is never zeroed out. So we have to zero out the income statement and then transfer over $400,000 to retain earnings. So retained earnings is a sum of all your prior net incomes. So the net income at the end of the year is $400,000. So you see how it's 5.4 million in cash, 5 million owner's equity, 400,000. That's how 2021 balance sheet will start. It's going to look at exactly like the end of 2020, the balance sheet. The 5.4 million in 2021 is going to start that way. We can do our statement of cash flows, right? So to calculate cash flow from operations, you start with net income, and then you have to adjust for the non-cash items on the income statement. But there's no non-cash items. It's a pretty simple first year. There's nothing from cash flow from investing. We didn't buy any factories or equipment or anything like that. But there was a cash deposit of $5 million. That goes into the cash flow from financing section. So this is our completed financial statements. So you should always make sure change in cash was 5.4 million, because our net cash flow from operations plus cash flow from investing plus CFF, cash flow from financing. You have to sum these three up. So there's an inflow of $5.4 million into our business. And you have to make sure your cash balance, we started out with zero because it was our first year, and now we have 5.4 million at the end of 2020. So our cash balance increased 5.4 million, which matches the change in cash. And now you can see our free cash flow, which is cash flow from operations minus capital expenditures, is 400,000, and our net income is 400,000, which is not always the case. In this case, everything was done in cash, so the amount of cash our profit equals our free cash flow. But you're going to see in future years, it's not always that rarely happens with businesses. Does that make sense to everybody? On 22. So 2021, everything's zeroed out on the income statement, statement of cash flows, and the balance sheet is always a running total. So now we have to do there's transactions that occur in 2021, and that's what we're going to do now. So the first transaction is we buy inventory because we have no inventory from our supplier Slippy. So 5 million of inventory. Send them cash, 5 million. So we're going to minus 5 million. And then increase inventory, 5 million. So it's just everything we did was contained within the asset section. We increased one asset and decreased another asset. So it kept everything equal. Assets equal liabilities plus equity. The next thing is we're going to sell inventory to Walmart. So when we sell them inventory, we're going to sell our entire inventory, all 5 million. So we can remove it from the balance sheet and then put it onto cost of revenue. And you see our balance sheet doesn't balance because we have to transfer over everything from the income statement to the balance sheet. So that's part of the balance sheet. This is part of the equity section, but that doesn't get zeroed out to the end of the year. So in this case, Walmart didn't pay us all in cash. They paid us half cash, half credit. So we're going to charge them $10 million because we double our inventory. That's our markup. So we're charging them $10 million. They're going to give us five in cash, 5 in receivables. But regardless of how they pay us, whether it's cash or on credit, we have to book all the revenue. Because the income statement, anytime a transaction is complete, we have to book it. But the cash may not come in for a long time. So they're going to give us 5 million cash. And they're paying 5 million on credit. So in the future, they're going to pay us that $5 million. And now, since we're getting busier, we're going to buy a machine to help us make the slippers quicker. So for $1 million machine, so we're going to send $1 million check to the company that makes the machine. And then, so $1 million in cash goes down. Now $1 million in PP&E, property, plant, and equipment, goes up. So the changes all were contained within the asset section. And you have to depreciate the machine. Even though you spent $1 million, you're not going to put the entire $1 million onto the income statement. Even though the transaction occurred, what you're going to do is spread the cost over a number of years. So the useful life of this machine is 5 years. So you're just going to do $200,000 a year for 5 years. So you're going to put $200,000 on accumulated depreciation, and then $200,000 as an expense on the income statement, because you have to pass that expense. And this is a contra asset account, accumulated depreciation. So you don't add it. Like, if you want to know the sum of your assets, you would do cash plus accounts receivables plus PP&E minus accumulated depreciation. It acts the opposite of a traditional asset account. And we've 10 workers, again, $50,000 each. So it's $500,000 we have to pay. So $500,000 in cash. And then that goes in the cost of revenue because they were part of making the actual product. We're going to have next year, we're going to hire another worker, an HR woman or person, and their salary is not going to be in cost of revenue because they're not involved in making a product. Now we have to pay taxes. So I just made it 20% on our profit, 4.3 million profit. Gross profit was revenue minus cost of revenue. Then we have to minus depreciation because that's an expense that gets passed through into the income statement, even though it's a non-cash item. And then 4.3 million profit, we pay 20% in taxes. So $860,000, we're gonna have to cut a check to the IRS. So we minus 860 from cash. And then the 860 goes onto the income statement. So all these accounts on the balance sheet are kind of like stored somewhere. Same thing with the income statement. These are accounts also that contain money. And then the last thing you do, we did all our transactions for 2021. The last thing you do is you move everything onto, you have to zero out the income statement. So we're going to move all our net income to retained earnings. Even if it's negative, it goes to retained earnings. And now reconciliation, our numbers reconcile, our balance sheet reconciles. And when we start 2022, our balance sheet will look exactly like this, and our income statement and statement of cash flows will be zeroed out. Hey, what's up, Dow, Eamon? If check out Dow's Stock Talk. He also does stock videos and different financial stuff. Okay, so 2021. So let's do the statement of cash flows. So we could look at our financials and see how we did for the year. So we have to first calculate CFO, cash flow from operations. You start with net income. And you have to let me just change the order around. usually non-cash items will come above changes in working capital. Um, Not that it matters, but okay. So to calculate cash flow from operations, remember I always say in every video, it's you think of it as net income converted to cash. So you just want to convert because this is not cash. We didn't get $3.4 million. We'll see how much cash we got. So we have to add back the 200,000 of depreciation because that's a non-cash item, and then changes in accounts receivables or anything in working capital, changes in inventory, accounts payables, accounts receivables. That also goes on the cash flow from operations section. So our accounts receivables last year was 0, and it went up to 5 million. So when accounts receivables goes up, cash goes down. Because we had a book that it's a little confusing and it's hard to kind of explain it, but when we book the revenue, the entire 10 million of revenue from Walmart, they paid us. But remember, they only gave us 5 million of cash and 5 million receivables. So that's like a cash negative because we should have received that other 5 million, but they it was on credit. When we do receive the 5 million, which will be next year, then we add it on statement on cash flow from operations section because it's like a cash inflow when they actually pay us. Right now, it's a cash outflow. Okay, I was getting confused for a minute. There's so many moving parts. Is this clear? Does this make sense? It's I I built it and it's confusing sometimes to me because there's so many. Okay, so even though we reported $3.4 million of profit, we actually lost $1.4 million of cash for the 2021 from our operations. And we also had capital expenditures. We had that $1 million machine we bought. Okay. And nothing from cash flow from investing. We didn't receive any debt or equity financing. Hey, what's up? Thanks for joining. So this is the end of 2021. What does it say how long it's been on the live stream? 0 o'clock? Oh, right, 24 minutes. Okay, so end of 2021. So we're going to look at our financials to see how we did for the year. So even though we reported $3.4 million of profit, we actually lost $2.4 million of cash, which you might say, oh, that's bad that they're losing all this cash. But then if I said, but the main reason is we sold $5 million on credit to Walmart, and it's not much of a credit risk. Walmart's they're gonna pay. They're not gonna go out of business. They might just take a little longer to pay, but there's really no risk. So if you factor that in, we didn't really do that bad, but it looks bad, losing $2.4 million of cash while reporting a $3.4 million profit. So our cash balance went down 2.4 million. And if we look at cash in 2020, it was 5.4 million, right? The end of 2020, and the end of 2021 was 3.04 million. And the difference is 2.36 million, negative 2.36 million. And that's our change in cash for the year. So the sum of everything on statement of cash flows will equal the change in cash from last year to this year. That's just a check. Is people following, or is it too confusing? Okay. Well, I'll keep going and let me know if it's too confusing. There's only 7 people here, but okay. So 2022. So this the end of 2021 will look identical. So yes. What does yes mean? It's confusing. It doesn't make sense. So 2021, the end of the balance sheet will look exactly like the beginning of 2022. And the income statement and statement of cash flows will be zeroed out because no transactions have occurred. And now we'll start the year of 2022. But you can ask questions. Okay, so the first thing that happens in 2022, we receive 5 million of cash. Okay, good. We received 5 million of cash from Walmart because they owe us 5 million from last year because we sold them product on credit. So cash goes up 5 million. And then we wipe out our accounts receivable. So everything that changed was contained within the asset section. That's not always the case. Sometimes it's on liabilities, or sometimes it's within the equity section somewhere. Okay, so the next thing is we need inventory. We don't have any inventory. So we're going to buy 10 million from our supplier, Slippy. And we're not going to actually pay him this time. So he's going to give us the inventory. And we're going to buy on credit because we've been pretty good customers. So at this point, he says, okay, I trust you're going to pay, so I'll sell on credit. So now we have to book accounts payable. So now it still reconciles. Assets go up 10 million, accounts payable goes up 10 million. So everything's reconciled. The third thing is we're going to sell inventory to Walmart. We're going to sell our entire inventory again. So we just take the inventory from Slippy, the generic slippers, and kind of make them nice. So that's why we mark them up and sell to Walmart. So they're going to take our entire 10 million of inventory, and that's going to go into cost of revenue. And then, so it's 20 million of revenue with the book, because that's what we're charging them. Doesn't matter how if we get all the money or none of the money, we have to book the revenue. And this time they're going to pay us half in cash, half on credit. So we have to add 10 million cash and 10 million accounts receivables. Let me delete this to taxes because it kind of makes things confusing. Okay, this kind of makes it clear. I'll delete tax over here. So the balance sheet doesn't balance. Assets do not equal liabilities plus equity. It's off $10 million, and it's off this $10 million because that's going to get transferred over to retained earnings, and then it will balance. So it does balance. Now we have to depreciate the machine. We depreciated it last year. We're due at $200,000 every year. So let's depreciate another $200,000. So we decrease our assets $200,000. And then we decrease our equity $200,000. Remember, accumulated depreciation is a contra asset account, so it acts the opposite. So to get your total assets, you have to sum everything, but you have to minus accumulated depreciation. Does anybody know why it's broken out like this, 2 lines? Like, why can't we just have PP&E 600,000? Because that's what it really is. It's $1 million minus 400,000 depreciation. That's the value of the machine according to our balance sheet, $600,000. So why don't we just get rid of this line and just put 600,000 here? Because that's what it is, right? It just gives more information, because if somebody was looking at the looking at the balance sheet, they would see the original cost of the machine and how much it's been depreciated. If it just said $600,000, the person looking at the balance sheet wouldn't know, is that how much they paid for it, or is that with the depreciation, and how much did it depreciate? So it just gives more information to break it out like this, to have accumulated depreciation. 14 people, getting up there. Okay, so now we're IPOing. Okay, the company's growing, and we want to go public. Does anybody know why? Why would you even IPO? Like, what's the benefit? Why not just keep it? We're making money. Let's just keep it the way it is. It's a good way to monetize your investment. You know, if you own this company, or if you're a part owner, you can get a really fat paycheck once you IPO. If you own 10% of the company, because the value of the company goes up a lot. Like, once you go public, like, say it's valued, this is not valued at $1 billion, but say you have a private company that's valued at $1 billion. When you IPO, it'll probably be valued at $2 billion or $3 billion. It's just the value goes up, and then after the lockout period, after a few months, then you can just sell your stock and cash out. But anyways, okay. So we're going to IPO for $50 million. So we're going to sell 10 million shares into the open market at $5 each. So I guess it's a penny stock, but so what happens? Well, obviously cash goes up $50 million. That's part of the company's cash. So cash, it goes up 50 million. But now this is a little confusing. How do you report the 50 million in the equity section? Okay, so when you like each share of stock, each share of the 10 million shares, they have a par value associated with them. And it's usually a really small number, like a penny. I'm using a penny per the par value for each share. It's just an arbitrary number. It's more to keep track of the number of shares in the market. It has nothing related to how much the stock is worth. The stock could a share go up to $10,000. It's still going to stay a penny on it. Just a par value. It's just a way to track the shares in the market. But you have to assign a par value. Some companies do 1/100th of a penny. So I just did 1 penny. So 1 penny times 10 million shares is $100,000. So that goes into common stock, $100,000. Additional paid in capital is a difference between how much you raised, the 50 million, minus the $100,000. So when you look at the income statement, and I keep saying income, when you look at the balance sheet, the equity section, additional paid in capital is how much money you raised. When it says common stock or maybe stock, it's usually a really small amount. Sometimes it's just a few $1,000s. That has nothing to do with how much you raise. It's additional paid in capital. It's just a difference between the cash amount and the common stock. So 49.9 million additional paid in capital. I talk about some of the stuff on my video. Actually, I've been talking about the equity section in each video now. Let me know if anything's confusing. This is the most simple way I could kind of like come up with this stuff. It can get pretty complicated. Like for instance, we probably when we have buy the slippers and we make them nice and sell them to Walmart, we probably would have a lot of other expenses in there. Like we have to buy like maybe like beads or like string or like things to add to slippers. I didn't even add all that stuff in because I thought it would just be confusing. So I'm making it really simplified, but there will be tons of other stuff going on. So now we have 15 workers instead of 10. So 750. So $750,000 we have to pay in payroll. That comes out of cash, and we add it to cost of revenue. Now, now we're going to hire an HR person because it's getting busier and we need more help. And we're going to pay them $70,000. So that comes out of cash. But their salary doesn't go into cost of revenue because they're not actually making any products. They're not like, the cost of revenue is the cost directly associated to generating the revenue. I mean, they're part of the company, but they're not directly generating the revenue. They're just kind of operational. Like if you had accountants or lawyers or the CEO, that doesn't go into cost of revenue. That goes in selling, general, and administrative expenses. So we'll put their salary in SG&A because it belongs below gross profit. Now we have to pay taxes. So we just do a flat 20% in taxes. So 2.1 million. So that comes out of cash, and we mail a check to the IRS. And usually the amount you pay the IRS is different than what the income statement says. Like if the income statement said 2.1 million of taxes, you may actually pay the IRS 1.8 million or 2.4 million. It's almost never what it says on the income statement due to all the accrual accounting, like, you know, all these non-cash items like depreciation or and then I think I mentioned in a recent video, and then you have to book that term? Um, oh yeah. Then you have to book a deferred tax asset or deferred tax liability, depending on if your income statement is more than the amount you paid or less than you paid. But whether you pay more or less than your income statement, it doesn't really matter because the next reporting period it'll even out over time. It's just for some reason the IRS has different ways of calculating taxes than GAAP accounting. Um, but these, I mean, I guess it's good to know, but it's kind of meaningless. You don't really need to know this stuff to figure out if the company's worth investing in. Um, that's kind of a minor thing. It'd be good to know like their future plans or their growth and things like that. Um, but it is interesting to learn this stuff. So, anyways, so the year is over. We had $8.4 million of net income. That's what we report as profit. Did anybody see last year when Macy's was trading at like $7? My video was like, it was a little more than a year ago. I had made a video. It was like $21.40. I said in the video, and it closed today at like $21.60, something like that. And some people were saying Macy's, it's a dead company. It's going to go bankrupt, but their numbers look really good. Like they didn't look like a bankrupt company. They didn't look like a company that was in trouble. Um, okay. Anyways, so we have to close out the year and move. Um, okay. What did I do? Shit, I messed up. What, did anybody know what I did? I'm off. I'm off. It gets too confusing. 1.5 million. I'm off 1.5 million. Did I not put something in a spot? 1.5. Okay, I bet you it's just 750,000. Yeah, I didn't. I put a positive 750. Should be negative. No, wait, it should be positive. My, and did anybody see what I did wrong? Now I gotta go through this. Let's just see. My cash is off. Um, that makes sense. My cash is off. It doesn't make sense. If I'm off 1.5 million, why is my cash off only 500,000? This is annoying. Okay, this is what happens when you go live. This is the risk. Oh, did anybody notice it changed from owner's equity to stockholders' equity because now we're public. So stockholders own the company, not the owner anymore. Okay, so 3040, and then we get 5 million of cash from Walmart to start the year. Then we add 10 million of cash from Walmart from the sale, and then 50 million of cash. Minus 750. I bet it was. If I I'm going to move the retained earnings over. Since nobody caught what. Oh, shit. Okay. My retained earnings is off also. Okay, let's see what I did. Okay, I did a formula here. Okay, there it is. I should stupid doing a formula there. I doubled the cost of revenue because it was 10 million initially. So I wanted to make it 20 million, but then I added the payrolls. Okay, so now it tied. So our net income equals what we're off on a balance sheet. So now we have to move our net income over to retained earnings to close out the year. And we reconcile. Now let's do our statement of cash flows. So to calculate statement of cash flows, you start with net income. Well, we're doing CFO first, cash flow from operations. Then you have to add back your non-cash items from the income statement. The only non-cash item was the depreciation. The reason we add back depreciation is because we initially took $1 million charge in 2021 when we bought the machine. So we can't reduce cash anymore. We already reduced our cash $1 million. So to adjust, we have to add back the depreciation and cash flow from operations because we minused it on the income statement. We add it back on the CFO section, so it kind of equals it out. Accounts receivable was 5 million in 2021. Now it's 10 million. So when accounts receivable goes up, cash goes down. So it went up 5 million. So cash goes down 5 million because that's 5 million of cash we didn't receive. And then accounts payable was 0 last period. We didn't have any. Now it's 10 million. When accounts payable goes up, cash goes up because it's same as a loan, right? Accounts payable, we received $10 million of product from our supplier, but we didn't pay any money. So it's a cash inflow of 10 million. When we actually pay it, which would be in 2023, then it'll be a cash outflow. What are we on now? 50 minutes? Okay, so nothing from investing, or we didn't buy any machines or anything like that. No stock. Well, what am I saying? Nothing. So we have to add 50 million because we sold stock. So we get 50 million of cash flow from financing. So if we sum up those three sections, we had a change in cash of $62.4 million. And a way to reconcile that is in 2021, we ended our balance sheet with $3 million of cash. See 3040? And now we have $65.4 million of cash. So our cash balance went up $62.4 million, which is changing cash from the cash flow from operations section. Now, if you look at our financials, you can see we reported $7.2 million of profit, yet our free cash flow, we don't include the common stock. Our free cash flow went up $12.4 million. So that looks good, right? Because last year we reported a profit of $3.4 million, but we lost $2.4 million of cash. And this year we actually brought in $5 million more of cash than the prior year. I mean, then we report as a profit. So if you were an analyst or investor, you might say, "Oh, you might say that's really good that you're bringing in more cash than what you show as a profit." But then then if you look at the cash flow from operations section, you would see that this $10 million of accounts payable is a big reason why we had so much extra cash. Next, when we actually have to pay it, which will be probably next year, then it's going to negate our cash for $10 million. So 2023 is over. Our balance sheet for 2024 will look exactly like the end of 2023, and this will be zeroed out. Yeah. No questions? Or is this interesting, or just want to make sure? So 2023 begins. We have no transactions, so nothing on the income statement has occurred yet. Our balance sheet is never ending. It always rolls along, goes up or down. So the first thing that happens is we receive $10 million from Walmart. They were supposed to pay us last year, but we extended credit to them of $10 million. So our cash goes up $10 million, and our accounts receivable, we can wipe out our accounts receivables because they're paying off what they owe us, which is good. That's a cash inflow, right? And then we're going to pay our supplier $10 million. Slippy, because he sold us on credit the prior year. Will you post this stream for viewing later? Oh yeah, it's a live stream. It'll be posted. It probably won't be so great. I actually tried to do this video a couple of weeks ago, but the microphone I had before, it was a really expensive microphone, but it sucked. It just kept screwing up. So it's really annoying. Well, thank you. I appreciate the donation. It's really nice. So we have to pay our supplier $10 million because he extended credit to us last year. So we still owe him the money. So we're going to wipe out our accounts payable, and we have to minus $10 million from cash. Okay. So now the third transaction is we're going to buy inventory on credit. Again, we're buying on credit. He's going to extend us more credit, 30 million of inventory. So our inventory goes up 30 million. our payables go up 30 million. Do we add that 499? Yeah, I got to add the 499 to CFO, but I have to pay taxes on it too, so it sucks. That's funny. See, these are pretty simple financials, but it's really easy to mess up. Although companies, it's all computerized with companies. I mean, there are some manual parts, but a lot more automated. I could have made this automated too, but where I just put the numbers on this column and they would all populate in here. But then it would be hard to explain it that way. Now Walmart they don't want all our inventory. They just want to buy 20 million of about 30 million. So our inventory goes down to 10 million. Our cost of revenue is 20 million. So we have to book the revenue and cost of revenue once the transaction occurs. Yeah, it is probably late. Actually, I'm flying to New York tomorrow morning, so I'll be in New York the whole weekend. New York City. But yeah, over there it's probably 10:30. So you have to book the revenue, cost of revenue onto the income statement, regardless if you receive money or not. So we do that. Yeah, I reduced my inventory 20 million. I booked the revenue, cost of revenue. But they're going to pay us. They owe us $40 million because that's how much we charge them. So they're going to give us 20 million of cash and 20 million on credit. And now we have to pay our employees, 15 workers, $50,000 each, so minus 750,000 cash, and add 750,000 to cost of revenue. And then we have our payroll, our HR person, 80,000. We raised their salary. So that goes in SG&A, selling, general, and administrative expenses. Comes out of cash. It's good to look. Net income is what we're off on our balance sheet. So we do reconcile because we have to transfer this over to retained earnings. It's always good to double check after each transaction to make sure you didn't enter something wrong. Let's pay taxes, 3.8 million. I move. Did I do the good work? Okay, let's just pay taxes. I'll go along my checklist. Three, four. Why do I have an asset impairment on here? I don't mess this up. Okay. Okay. before we move our net income to retained earnings, there's the machine we have, according to our balance sheet, it's worth $600,000. It's a million minus $400,000. We depreciated it the last 2 years. But there's a new model out of this machine, and the machine we have is worth nothing. Like if we try to sell it, there'd be nobody would want it because the new machine is actually cheaper and better. But it doesn't mean we have to throw the machine away. We could still use it. We could use it for a long time. It's just, according to our balance sheet, we have to accurately reflect our assets. So we're going to pass through an asset impairment. Onto the income statement. And we're going to remove these two items because we're going to make the machine worth nothing. It has no value anymore. So we have to remove it from the balance sheet and not report it as an asset. Because when someone like an investor or a bank looks at your balance sheet, if you had to liquidate your company, they would want to know like what they could get for these assets. And if they get nothing for it, that's what you have to put. So that's why we're passing through an asset impairment. So we're reducing the value of the asset, $600,000, which is what the carrying value was, and we're passing that through as a loss. Did I mess up something? Why did I have? Maybe that's why I had. I can't remember. Maybe that's why I had the asset impairment below. I can't. Let's figure out the asset impairment out. You could probably watch the video. It talks about it on the video. It must if it's on here. Let's just figure out the asset impairment. I'll just gray it out. I didn't really prep for the video. So we're going to move over to retained earnings to close out the year. And 8 people. There's still, we're going to do an acquisition actually. After we do the financial. So let's just do. Oh shit! I didn't do taxes. Oh my god. We got to pay taxes. 334 and retained earnings. Okay. So taxes So we have to minus cash, and then we transfer over to 15.3 million of retained earnings, and that's the end. Now do the statement of cash flows. We start with net income. Forget about that. I guess this is killing me. The asset impairment. I guess we'll just ignore it for now. Now we have to adjust for changes in working capital. So accounts receivables went from 10 million to 20 million. So when accounts receivables goes up, cash goes down. And inventory, it was 0 last period. When inventory goes up, cash goes down, because that's a cash outlay. Sometimes when companies buy lots and lots of inventory, it could really negatively affect their cash flow, like during the holiday season. So it could look like they're losing a ton of money, a ton of cash, but they're just setting themselves up for the Christmas season. And accounts payable went up. It went from 10 million to 30 million, so it went up 20 million. So our cash went from 65.4 million to 80.8 million. So our cash went up 15.3 million, which was the same as the change in cash from the statement of cash flows. I gotta watch that video again on asset impairment. But anyways, so we also are acquiring a company, Sandals Beyond Retail, with all cash. And so this is outside of the statement of cash flows. So we're acquiring a company, so we have to reduce cash by 5 million. And then the company that we're acquiring has 4 million of inventory. So we add 4 million of inventory, and we add 1 million of accounts payable, because they owe some money. We have to take on their debt as well. So even though we paid 5 million for this company, the value of the company was 3 million. They had a really simple balance sheet. They only had inventory and accounts payable. So their assets were worth $3 million. That's how the value of a company is assets minus liabilities. And then whatever you pay for them, if you pay more, which we did, because assets minus liabilities is 3 million, we paid 5 million for the company. So the $2 million we have to plug into goodwill. And that's an intangible asset. Goodwill is just a plug to reconcile the acquisition. It's kind of like a meaningless asset. But in future years, we may pass through goodwill impairments if the sandal company isn't bringing in much revenue, and it's not as profitable as we thought. We might have to reduce our goodwill to reflect that and pass through a loss onto the income statement. Okay, this was this was a long one. I hope. Thanks if you stayed the whole time. Really appreciate it. I, I know it was hard to follow some parts, but yeah. So I'll see you guys around. I have some videos in the queue. Thanks a lot. Really appreciate the donation. I have videos queued up. I could tell you what they are. So this isn't. Okay, here's all my. So tomorrow morning, Idea Ideanomics. It's an interesting company. Then on Saturday, British American Tobacco. Sunday is Walgreens. Monday is Wimmy, and Tuesday is Infrastructure Energy Alternatives, IEA. So it's all queued up. I get back Sunday night from New York. Okay. Well, thanks for sticking around the whole time if you did. And I'll see you guys later. I'll talk to you in the comments. Have a good night.